Hello traders, have you ever entered a trade thinking that the trend will continue only to watch the market suddenly reverse? Maybe you had entered a buy trade after this particular surge happened and then a pullback happened, and maybe you thought, oh wow, this is a great place to enter a buy, and before you know it, after a brief consolidation, a reversal set in. If such a thing has happened to you before, then this video is for you. That is the reason why trend reversal indicators are crucial, because they help traders spot market shifts early and time their entries more effectively. So in this video, we are breaking down the best trend reversal indicators that can help you stay ahead of the game. Welcome back to the channel. If you're serious about improving your trading, smash that like button and hit subscribe so you never miss powerful trading insights. In this video, we are talking about how to identify trend reversals using the best indicators. Knowing when a trend is about to change can be the difference between a great trade and a costly mistake. So let's just dive right in, okay? What exactly is a trend reversal? Let us understand the concept. What exactly does reversal mean? Basically, a trend reversal happens when the market shifts from an uptrend to a downtrend, right? Or vice versa. Recognizing these shifts early can give traders a huge advantage. So, for uptrend to downtrend, it is when higher highs, right? When higher highs and higher lows, higher highs and higher lows turn into lower highs and lower lows. So when higher highs and higher lows turn into lower highs and lower lows, then you have a bearish reversal. You have a reversal from an uptrend to a downtrend, like what happened here. All right, then for downtrend to uptrend, it is when lower lows and lower highs start forming higher lows and higher highs. That's when you have a bullish reversal. In that case, it means that a downtrend turned into an uptrend. So the question is, how do you know if a trend is actually reversing or just taking a short break? That's where trend reversal indicators come in. So now let's just quickly go over the top 3 indicators that traders use to spot market reversals with accuracy. The first is divergence, and with divergence, you can use RSI, for example, or MACD. So divergence occurs when price moves in one direction, but an indicator moves in the opposite direction. For a bullish divergence, price would make lower lows, but the RSI or the MACD will make higher lows, like what we can see happen here. Can you see that? You see that the momentum indicators made higher lows, but the price made lower lows. So this is a bullish divergence because it indicated a possible reversal to the upside, like what we can see happening right now. Then for a bearish divergence is when price makes higher highs, like what we can see happen here. You can see that we actually had higher highs even up to this point, higher highs, right? But then the RSI or the MACD makes lower highs. You can see lower highs. So in this case, we have a bearish divergence because the indicators are in the divergence scenario is indicating a possible reversal to the downside. what we can see happen here. This works best when combined with support and resistance levels. Okay. Now, the next trend reversal indicator we're going to be looking at is the moving averages, specifically EMA crossovers. So moving averages help smooth out price action and identify trend direction. Let us add the 9 EMA and the 50 EMA to the chart, for example. All right, this is the 9 EMA. Let's just increase the thickness, and then this is the 50 EMA. Let's change the color and increase the thickness. Change the input to 50. All right. So now a bullish reversal occurs when a shorter EMA, for example, the 9 EMA, crosses above a longer EMA, for example, the 50 EMA. So this was a bullish reversal that occurred here. And then a bearish reversal happens when the shorter EMA crosses below the longer EMA. So we had a bearish reversal happening here. And this works well in strong trending markets and help confirm momentum shifts. Then finally, we have the price action reversal patterns like double tops, double bottoms, you know. For example, we can see an example of a double top here. A double top is an example of a double top. It's a price action reversal pattern. Double tops and double bottoms, they are classic reversal patterns that signal trend exhaustion. And then another example is head and shoulders pattern. It's a strong bearish reversal signal. Then we also have candlestick patterns, a lot of them. One of them is the engulfing, bearish engulfing pattern. For example, you can see what happened here. When the bearish candle swallows up the previous bullish candle, that's for bearish engulfing. The bullish engulfing is when the bullish candle swallows up the previous bearish candle, right? Have a bearish and a bullish engulfing. Okay, so price action is one of the most reliable ways to confirm trend changes when combined with indicators. Now that you know the best trend reversal indicators, here's how to use them effectively. The first step is to identify the signal. All right, you look for divergence, EMA crossovers, or price action patterns that indicate a potential trend shift. Then the second step is to confirm with other tools. You can check for confluence using support and resistance, trend lines and volume, all of that, right? And make sure you always get your confirmation candle. For example, in this case, you can see that we had a bullish trend, and shortly afterward, there was a breakout. There was actually a double top pattern, and you can see this EMA crossover. So we had confirmations, right? So this would have been a great place to enter a sell after our confirmations, and then you can set your stop loss above the previous swing high, and then you can target key levels for your take profit. All right, ensure that you manage your trades effectively, watch price action closely, and take your profits at key levels. Even with the best indicators, traders still make mistakes when spotting reversals, and here are some key mistakes to avoid. One is ignoring the overall trend. A minor pullback is not always a reversal. Sometimes it might just be a pullback. All right, pullbacks and reversals are not the same. Okay, so when you have a pullback, you should not mistake it for a reversal. And then do not make the mistake of entering too early. Wait for confirmation before taking a position, and do not use only one indicator. Always combine multiple indicators for confluence. Furthermore, do not forget risk management. Always have a stop loss in place to protect your capital. So by avoiding these mistakes, you will be able to trade trend reversals with more confidence and accuracy. And that is how you can use the best trend reversal indicators to time market shifts effectively. Knowing how to spot and confirm reversals can help you avoid bad trades and make smarter trading decisions. If you found this video helpful, hit that like button and subscribe for more expert trading strategies. Also, drop a comment below. Which trend reversal indicator do you use the most? Let us discuss. Thank you for watching, and I hope to see you in the next video. Happy trading.